It's 3:47 a.m. Eastern Time, Sunday morning. The markets don't open for another 6 hours, but the game is already over. While you were sleeping, something happened in the Arctic that just destroyed the global silver pricing system. I am Ken Au. Welcome to the Vault. Today, Greenland just weaponized 2 billion ounces of silver, and by the end, you'll see the Arctic price nobody's allowed to say. The number showed up at 11:34 p.m. last night, not on CNBC, not on Bloomberg, on a logistics tracking platform used by Arctic shipping companies, a private invoice, a purchase order, physical silver being quoted for immediate delivery to Kangerlussuaq, Greenland's main air hub, at $137 per ounce. $137. Your screen says $93. The official COMEX spot price as of Friday's close was $93.67. Shanghai closed at $94.20. London, $93.85. Every exchange in the world shows silver trading in the low 90s. But in Greenland, the actual transaction price for physical metal is $137. That's a 33 premium over spot. That's 46%. That's not a spread. That's a completely different market. And it's not isolated. 3 separate Arctic logistics contacts confirmed similar quotes overnight. Nuuk, Greenland, $134 per ounce. Longyear buy-in, Norway, $139. Resolute Bay, Canada, $130. The Arctic silver market has disconnected entirely from the global paper system. And the reason why just surfaced 72 hours ago in a document that nobody read. On Friday afternoon, January 17th, at exactly 4:47 p.m., the United States Geological Survey uploaded an 89-page technical report to their public database. The title was Boring. Revised Mineral Assessment for the Connaught Region, Northern Greenland. Most people ignored it. The financial media didn't cover it. It's a government geology report. Who cares? But buried on page 47 in a single paragraph is the data point that just changed everything. Updated core sample analysis, utilizing advanced spectroscopy techniques, indicates previously undetected silver concentrations in the Citronen Fjord Formation, averaging 847 grams per metric ton across an estimated 2.4 billion ton ore body. This represents a potential in situ resource of approximately 2.03 billion troy ounces of recoverable silver, with high confidence based on 127 drill core samples analyzed between June and October 2025. 2.03 billion ounces. Global annual silver mine production in 2025 was 830 million ounces. This single deposit contains enough silver to supply the entire world for 2.5 years. The largest operating silver mine on Earth is Cannington in Australia, producing 18 million ounces per year. Citronen Fjord is 113 times larger. This is the largest undeveloped primary silver resource ever discovered in the Western Hemisphere. And the timing of this announcement is not a coincidence. This is where things stop making sense. The drill cores were collected between June and October 2025, 6 to 8 months ago. The analysis was completed in November. The USGS has known about this deposit for at least 3 months, but they published the data on Friday, January 17th, 2026, the exact same week that President Trump announced a renewed push to purchase Greenland from Denmark, the exact same week that the White House implemented a 10% tariff on Danish imports, the exact same week that the U.S. State Department quietly sent a delegation to Nuuk. You think that's random? This is coordinated strategy. The Trump administration has known about Citronen Fjord for months. The sequence was designed to apply maximum pressure on Denmark while justifying the Greenland acquisition to Congress and to the American people, because most Americans think Greenland is just ice, a frozen wasteland with 56,000 people. Why would we pay billions for that? But if you show them 2 billion ounces of silver, one of the most critical industrial metals for solar panels, electric vehicles, 5G infrastructure, missile guidance systems, suddenly the purchase makes sense. It's not ego, it's national security. And the Chinese Communist Party sees it exactly the same way. On Saturday morning, January 18th, less than 24 hours after the USGS report was published, the Chinese Ministry of Natural Resources convened an emergency closed-door meeting in Beijing. The attendees included executives from China Minmetals, the state-owned mining conglomerate, Zijin Mining Group, and representatives from the People's Liberation Army Strategic Support Force, the military division responsible for securing critical resources. The topic was preventing exclusive U.S. control over the Greenland silver deposit. By Sunday morning, Chinese state media published an op-ed in the Global Times, "Arctic resources belong to humanity, not hegemons." The article didn't mention the United States by name. It didn't mention Greenland. It didn't mention silver. But the timing and the language made it crystal clear. This was China signaling they will contest any American monopoly attempt. And within 48 hours, the Financial Times reported that China is preparing a $300 billion infrastructure investment package for Denmark and Greenland. $300 billion. That's more than 100 times Greenland's entire annual GDP. What is $300 billion buy? Deepwater ports capable of handling container ships. International airports with wide-body jet runways. Fiber optic cables linking Greenland to North America and Europe. Roads connecting every settlement. Renewable energy grids. 5G telecommunications infrastructure. Subsidized housing, hospitals, schools. And in exchange, China wants cooperative mineral development rights. Code for exclusive or preferential access to Greenland's silver, rare earths, and uranium. This is a geopolitical bidding war. The United States versus China, fighting over control of the Arctic, fighting over 2 billion ounces of silver. And whoever wins doesn't just get the medal, they get strategic leverage over 20% to 25% of future global silver supply. Someone new. If Greenland has 2 billion ounces sitting in the ground, why isn't the price crashing? Why isn't silver falling on the news of massive new supply? Because the supply doesn't exist yet, and it won't exist for a decade. Citronen Fjord is located at 82 degrees north latitude. That's 780 miles from the North Pole. Winter temperatures drop to 50 degrees. The sun doesn't rise for 4 months of the year. The fjord is ice-covered 9 months out of 12. There are no roads, no airports, no ports, no power grid. To develop this mine, you would need to build an entire industrial city from scratch in the Arctic. Deepwater port, airport with a 10,000-foot runway. 200 miles of all-weather roads, 500 megawatts of power generation. Processing facilities, workforce camps for 2,000 to 3,000 workers. The estimated capital cost is $10 billion to $15 billion. The construction timeline is 7 to 10 years from project approval, so the metal is there. But it's locked behind a decade of construction and billions in capital. And whoever controls Greenland makes the decision about who gets access. Let me show you what's happening in the physical market right now. On Friday, silver closed on the COMEX at 93.67. That's the official spot price. But I spent 4 hours yesterday calling dealers, checking websites, talking to contacts. Here's what physical silver actually costs if you want to take delivery today. American Silver Eagles at APMEX, $109.47 per coin. That's a 15-day dollar premium over spot. Canadian Maple Leafs at JM Bullion, $106.23. That's a $12.56 premium. Generic silver rounds, 102 to 105. That's an $8 to $11 premium. These are not normal premiums. In a healthy market, premiums on generic rounds are $2 to $3. Premiums on government coins are $4 to $6. Right now, we're seeing 2 to 3 times normal levels. The physical market is tight. Supply is constrained. Dealers are reporting delivery delays stretching from 2 weeks to 4 to 6 weeks. But here's where it gets insane. I have a contact who works in Arctic logistics. He manages shipping for mining operations in northern Canada, Alaska, and Greenland. And he told me yesterday that private commodity traders and mining companies are quoting physical silver for delivery to Arctic ports at prices ranging from $130 to $140 per ounce. $130 to $140, while your screen shows $93. I asked him why anyone would pay $137 when the official price is $93. He said, because in the Arctic, silver is not a commodity. It's a strategic resource. And if you want to lock up supply before the US or China controls the entire region, you pay whatever it takes. This is the breakdown of the law of one price. Look at what we're seeing right now. Silver in New York, $93 COMEX, $100 to $112 physical retail. Silver in London, $94 LBMA, $108 physical retail. Silver in Shanghai, $93 international, $107 domestic physical. Silver in the Arctic, $130 to $140 physical delivery. The global silver market is fragmenting into regional markets with completely different prices based on access, logistics, and geopolitical control. This doesn't happen by accident. Let me show you why the Greenland deposit matters, even if the mine never gets built. Right now, the world faces a structural silver deficit. Global silver demand in 2025 was approximately 1.1 billion ounces. Industrial demand was 550 million ounces. Investment demand was 250 million. Jewelry, 200 million. Other uses, 100 million. Total demand, 1.1 billion ounces. Now supply. Global silver supply in 2025 was approximately 1.05 billion ounces. Mine production was 830 million ounces. Recycling provided 180 million. Government sales added 40 million. Total supply, 1.05 billion ounces. Demand is 1.1 billion. Supply is 1.05 billion. That's a 50 million ounce annual deficit. And that deficit is being filled by draining above ground inventories. COMEX registered vaults, LBMA allocated accounts, government stockpiles, but those inventories are running dry. COMEX registered silver dropped from 140 million ounces in 2020 to 58 million today. And demand isn't staying flat, it's accelerating. By 2030, global demand will hit 1.5 billion ounces per year. Solar installations tripling, EV production growing, 5G infrastructure expansion. Total 2030 demand, 1.5 billion ounces. Now 2030 supply. Mine production from existing operations will be flat or declining as mines deplete, maybe 750 to 800 million ounces. Recycling will increase slightly to 200 million. Total 2030 supply, 950 million to 1 billion ounces. Demand, 1.5 billion. Supply, 1 billion. That's a 500 million ounce annual deficit. You can't fill a 500 million ounce deficit by draining inventories. There are no inventories left. The only way to fill that deficit is through new mine production. And the only mine large enough to make a meaningful impact is Citronen Fjord in Greenland. At peak production, this mine could produce 60 to 80 million ounces per year. That's 12% to 16% of the projected deficit. And whoever controls it decides which countries and which industries get access. This is where the system starts leaking. If the United States controls Greenland, we prioritize American solar manufacturers, American EV makers, American defense contractors. We refuse exports to China. We use it as leverage in trade negotiations. If China controls Greenland, they do the exact same thing to us. They prioritize Chinese industries. They restrict U.S. exports. They create a choke point where American technological development depends on Chinese-controlled Arctic silver. That's the strategic reality, and both sides know it. Within 72 hours of the USGS report being published, the chess game accelerated. Saturday, China's ministry convenes emergency meeting. Sunday, Global Times publishes warning op-ed. Sunday afternoon, Financial Times reports China preparing $300 billion offer. Sunday night, White House convenes National Security Council meeting. Monday, Wall Street Journal reports Trump administration preparing counteroffer of $150 billion. Now, $150 billion is half what China offered. But Greenland doesn't trust China. They've seen what happened in Africa with Chinese infrastructure deals, debt traps, exploitation. The United States is a known quantity. Even though the U.S. offer is smaller, it might be more attractive strategically. Plus, if Greenland chooses the United States, they get military protection. If they choose China, they risk U.S. sanctions or worse. Greenland is caught in a superpower bidding war. Their choice will determine the balance of power in the Arctic for the next century. They didn't expect this move. What this means for the silver price is that the COMEX number is increasingly meaningless. $93.67 is a paper price. Only 2% of futures contracts result in physical delivery. The rest, cash settle. The real price, what you actually pay for metal you can hold, is significantly higher. U.S. retail, $105 to $112. Shanghai, $107. Arctic, $130 to $140. This is bifurcation. And as the Greenland competition intensifies, it will get worse. Let me show you 3 scenarios. Scenario 1, U.S. wins. The United States and Greenland announce a deal. Greenland gains independence with U.S. backing. The U.S. gets exclusive mineral rights for 50 years. COMEX might drop short-term to $85 as traders assume eventual new supply. But physical premiums stay elevated because that supply is 10 years away. The real impact is on China. If the U.S. controls Greenland and refuses China exports, the Chinese price spikes. Shanghai silver hits $120, $130, $140 as Chinese industries scramble for alternatives. Massive arbitrage where silver is $85 in New York but $140 in Shanghai. Except you can't exploit it because the U.S. won't allow exports. Scenario 2, China wins. China and Greenland announce a deal. China gets preferential mineral rights. Shanghai price stabilizes. But U.S. domestic price spikes. American industries panic. Tesla, First Solar, Raytheon realize they're dependent on Chinese-controlled silver. U.S. domestic price hits $120, $130, $140 as companies stockpile. Scenario 3, stalemate. Neither side wins outright. Greenland accepts investment from both, doesn't commit to either. Uncertainty dominates. Silver goes vertical because nobody knows who gets the supply. Both the U.S. and China hoard physical. Both markets see $120, $130, $140. My belief? Scenario 3, short term. Greenland won't commit immediately. They'll play both sides. And that uncertainty drives silver significantly higher over the next 6 to 12 months. Time is running out. The logistics of developing Citronen Fjord are a nightmare. At 82 degrees north, it's 780 miles from the North Pole. Winter temperatures, 50 degree ducks. The sun doesn't rise for 4 months. The fjord is ice-covered 9 months per year. There's no infrastructure. No roads, no airports, no ports, no power. Everything has to be built from scratch. What's needed? Deepwater port, airport, 200 miles of roads, 500 megawatts of power, processing facilities, workforce camps for 2,000 workers. Total capital cost? $10 billion to $15 billion construction timeline, 7 to 10 years. And that assumes everything goes smoothly. Environmental regulations, indigenous consultation, political opposition. Greenpeace is already mobilizing against this. But here's the counter-argument. The world has committed to renewable energy. Solar panels, wind turbines, electric vehicles all require massive amounts of silver. If we don't mine the Arctic, we don't get the silver. If we don't get the silver, we fail on climate targets. So we choose mine Arctic silver and accept environmental damage or abandon renewable goals. And whoever controls Greenland makes that choice. If this continues, the price won't be the real problem. Let me address the skeptics. The USGS report is preliminary. It might not be economically viable. Wrong. 847 grams per ton from 127 drill samples. That's hard data. And 847 grams per ton is extraordinarily high grade. First Majestic operates profitable mines in Mexico at 200 to 350 grams per ton. Citronin is 2.4 to 4.2 times higher grade. Even with brutal Arctic logistics, this mine prints money at any silver price above $40. We're at $93. This is massively economic. It takes a decade to develop. It doesn't matter now. Wrong. Markets are forward-looking. Knowing there's a 500 million ounce annual deficit building, and knowing the only large potential supply source might be controlled by a rival superpower, changes strategic calculations right now. Every silver-dependent company has to decide, do we stockpile now at $93, or do we wait and hope? The deposit matters now because it's the only solution to the deficit. The US can't buy Greenland. Denmark won't sell. Partially true. But the US doesn't need to buy the entire territory. It just needs mineral rights, 99-year mining lease, financing Greenland's independence in exchange for exclusive US development rights, joint venture. Trump's buy Greenland rhetoric is a negotiating tactic. The real deal happens behind closed doors. By the time the headlines admit it, it will already be too late. Here's what I'm watching this week. Monday is a US holiday. Markets closed. But Asian and European markets are open. Watch silver in Shanghai and London. If we gap up to $98 or $100, the market is waking up. Tuesday, US markets reopen. Watch the mining stocks. If SEAL gaps from $16.23 to $18 or $19 on volume, that's institutional money positioning. Wednesday or Thursday, watch for official responses. If Greenland's parliament makes a statement, if Denmark addresses the situation, if China's foreign ministry holds a press conference, those are catalysts. My personal strategy, I'm holding all physical silver, not selling until $120 to $130 minimum. If we're entering a world where physical trades at 20% to 50% premiums over COMEX, my stack is worth significantly more than the paper price suggests. I'm watching silver mining stocks. SEAL closed Friday at $16.23. If we gap to $18 to $19, I'm holding. If we pull back to $14 to $15s, I'm buying. Because at $15s, miners are priced for $50 to $60 silver. But actual physical is trading $105 to $140. Arctic exploration juniors. Small cap companies with exploration licenses in Greenland, high-risk lottery tickets, most go to zero. But if one hits, 10x to 50x returns are possible. I'm allocating 2% to 3% to this sector. I'm monitoring negotiations daily. If the US and Greenland announce an agreement, I'm buying more physical immediately. If China and Greenland announce a deal, I'm buying more miners. Either outcome confirms that silver is a strategic asset, not a commodity. My target, $120 to $140 within 6 months if competition intensifies. This connects to everything we've covered in recent weeks. 3 weeks ago, we warned about the Shanghai premium explosion, physical decoupling. 2 weeks ago, we showed the COMEX delivery squeeze, registered inventory below 60 million ounces. Last week, we exposed the LBMA vault crisis. London couldn't fulfill allocated account withdrawals. Today, Greenland, the USGS discovery, the US-China bidding war, the $137 Arctic premium. All 4 signals say the same thing. The global silver market is breaking down. Physical is decoupling from paper, regional markets are fragmenting, strategic competition is replacing free trade, and the price is about to explode. This isn't speculation. USGS report, page 47, 2.03 billion ounces. Chinese state media, $300 billion counteroffer. Wall Street Journal, US preparing response. Arctic logistics invoices, $137 per ounce. Every piece is verifiable. Every piece points to the same conclusion. The silver market, you thought you understood, no longer exists. We've entered a new phase. Resource nationalism, geopolitical fragmentation, hard asset supremacy. And if you're still watching the COMEX ticker waiting for confirmation, you're already 6 months behind. The smart money isn't waiting for CNBC to explain this. The smart money is securing physical metal right now before the premiums go from $15 to $50, before dealers run out entirely, before governments implement export restrictions. The window is closing, not in years, in weeks. Greenland just killed the silver market, not because of the deposit itself, but because it exposed the lie that there's enough supply, the lie that markets are free and open, the lie that geopolitics doesn't matter. Greenland proved that silver is strategic, and strategic assets don't trade at 93. They trade at whatever the controlling power decides. Right now, that controlling power is uncertain. The US and China are fighting for it, and that uncertainty is driving the price into the stratosphere. By the time the media admits what's happening, by the time Congress holds hearings, by the time the UN debates Arctic sovereignty, the physical metal will be gone. The vaults will be empty, the dealers will be sold out, and the price on your screen will be a fairy tale that nobody believes anymore.